always good to get the feedback out of the way early. Good morning. Michael Moore, as I always say in these occasions, particularly in Scotland, recovered politician, now Chief Exec of the British Private Equity and Venture Capital Association. But all of that's irrelevant because you're not here for any of that. You're here because we have got Scotland's second Invest-to-Scale conference, and I'm delighted that, having been part of last year's inaugural efforts somewhere else in the city, we've now had this amazing new venue to come and gather at. And I mean, it was worth coming just for the screen alone. I think you'll think that. If we're talking about scaling up our operations, that has symbolised it, has it not? Over the course of today, and you'll have had, I'm sure, a quick peek at the agenda, the objective is to ensure that collectively we've got a really good sense of what is happening in the scale-up space. Many in this room are very much part of it already. This is about deepening your networks and your ties and making sure that together we can help Scotland scale up to the next level. If you have a wee look at the agenda, you'll see that over the course of the morning and the afternoon, we're going to learn from the experts who've already done it and who have gone on to other great things, although I'm sure there might be a moment or two of tales of failure along the way, because this is a far from linear process for anybody who's done it at any scale, for any length of time. We're going to dive into what are well-known, acknowledged success sectors like fintech. We've rightly got a deep dive into the issues surrounding talent, because capital and ideas are fab, but if you ain't got the talent, you ain't got a business. And we'll also, however, look at how best to use the different avenues to the different types of capital that are available, not least from some of our kind of government-backed institutions who now work a little bit competitively but very collaboratively across the Scottish scene. Later on, we're going to cross the Atlantic, get a sense of what it's like to take the business to the level where you're moving into international markets. And for the truly ambitious, there's the option of going to space. A few years ago, that might have been a bit of a joke. We would have thought, yeah, right. Certainly the classic Scottish reaction to most ambitious new things. But here we are today, looking at the serious progress that's been made, Scotland's positioning in a very exciting sector. And then we will meet with a few who are on the investor journey already, different kinds of experience, and we hope that through their experience we too can learn some valuable lessons. And of course, it wouldn't be Scotland if we didn't want eventually to allow ourselves to channel a bit of Rabbie Burns. And we've got some US investors who are joining us later in the morning and who, as we close the day, will allow us to see how others see us and their look at what the Scottish scene looks like when you come at it from the other side of the Atlantic. This is the bit where it all comes together, but if I may, I'd just like a moment to thank those who have spent the last year since the last Invest-to-Scale conference making sure that there would be a second one and that it would build on the success of last year. So to CT, Accountants and Advisors, Eden Scott, MBM Commercial and Angel Capital Scotland, the founding partners of this enterprise, our grateful thanks already, and I'm sure there'll be more to come. To our sponsors and event partners, Scottish National Investment Bank, Mark to Market, British Business Bank and Cazenove Capital, a special thanks to them. I know certainly from the BVCA perspective that the ideas for these kinds of events are one thing, the work is another, but actually getting them off the ground requires those sponsors to be fully engaged too. So thank you for that. And a wee special mention, she'll hate it, but I'm going to do it anyway, to the organiser's organiser, Susan Donald, who's standing in the corner there behind the screen so that nobody will spot her. But if you've had anything to do with this event over the last 2 years, she's been inescapable, and that's why people like me are back for a second year. Thank you, Susan, in advance. A few moments, if I may, to reflect on how things look from the perspective of the broader private capital industry across the United Kingdom. I have been involved with the British Private Equity and Venture Capital Association for the last 4 years, and I took over the industry body at a point when private equity, venture, angel, all different types of equity and other financing were at a point where they were getting more attention and not always all of it good. That might primarily relate to private equity, who are less the focus of today, but every so often tech, which was backed by angels or venture, was also in the headlines for the wrong reason. We've made a conscious decision, which I think fits the zeitgeist, that we should ensure that here and elsewhere in the UK, the private capital world and the people at back need to step into the spotlight, not least because there isn't a policymaker in the land. Whether you're looking along the road at the Scottish Government or down the road to Westminster and Whitehall, nobody is unfocused on the need for growth. It is the driving issue of our time, because whatever else you want to do in politics, and I tried a few experiments, you need the tax base to fund it, you need the wealth created, you need the successful businesses, not just for the taxes, but for the way in which they employ people. And if you look at where the most exciting developments are happening outside research labs or outside the public sector, or frankly, just in its own right, where is the most exciting growth? Where is the technological innovation, Where are people looking for opportunities in all parts of Scotland as well as the rest of the UK? You find it in private capital and what is going on there. It's been a fascinating journey for me in the last 4 years. Out and about around the UK, I still live in Melrose and do what many of you will do, travel down and back to London and other parts of the UK each week. It is an exciting moment, although very challenging. Nobody can escape the reality that post-pandemic, with the energy crisis, the inflation spike, and the interest rates changing from the 10 years of virtually zero interest rates, that has changed the calculus. However, when you look back, and this is our 40th year as an industry body reflecting the moment really where enough critical mass had arisen to start us on the journey, if you look over those 40 years, whether it's angel investors or venture investors or private equity investors, they've always invested through the cycle. Of course they do it wisely, of course they look at the different challenges that are coming, but out of those challenges, that great old cliche, many an opportunity is found. So what is exciting, I think, for all of us is that whether it's rewiring the existing economy to make it cope with artificial intelligence, the energy transition, the broader sociological challenges that face all of us, whether it's actually finding those solutions or adapting the existing economy to those challenges and making sure that we are winning as a result of it, not losing, you will, I think, always find the kind of people that are here today, the entrepreneurs, the people who are backing them with different types of capital, who are out on those journeys and really going to make a difference. Today in London, there is the Prime Minister's Artificial Intelligence Summit, which looks to address some of the big regulatory issues alongside some of the opportunities there are. It is a very important moment for that particular sector and a reminder to all of us that there's lots going on simultaneously with the challenges I've mentioned already, and it's good that policymakers are taking it seriously. Last week in London, we had the latest developments in our industry's efforts to ensure there is more capital available to invest in the scale-ups that we're focused on here today. It's one of the ironies of UK capital that Scottish firms or anybody from across England and Wales and Northern Ireland who want capital, 90% of it is raised from North America, Asia, or other parts of Europe. 10% of it only from here in the UK. So the breakthrough this year has been the way in which the City of London, with the pensions industry, with the Chancellor pushing them along, has first of all announced the Mansion House Compact, so 10 now institutions who will commit approximately £50 billion of capital by 2030 to put into the types of funds that back the entrepreneurs here. And last week, we were in the Treasury to sign the Venture Capital Investment Compact, which basically commits us as an industry to working with those pension providers to ensure that the capital can actually flow and then come to the opportunities here. So, lots happening, lots elsewhere that will continue to go on throughout the day and the weeks ahead. But for now, we want to ensure that we get here the focus on all the right things. I mentioned before, right at the start, that we were determined to give you the opportunity to hear from those who've done it before, might have one or two lessons for us from their experience. One of the people who is best placed to do that for us is now going to be in conversation with Kirsty Paton from CT, one of our founders. Shane Corstorphine, you'll know from Skyscanner, and that, you heard about that, I'm sure. Actually, if you look at what Shane has been involved in since Skyscanner, I think that's every bit as fascinating. But I'm going to let them tell the story. Ladies and gentlemen, please welcome Shane and Kirsty.
Just check the mic's working, yes. I've just realised I'm wearing the same dress as in my picture, which is kind of embarrassing. I need to go shopping soon. So we're going to have a quick chat through some questions. I'm going to grill Shane as much as I can, and Shane's going to try and answer my questions in the best way that he can. And then we're going to open up to the floor. If anyone's got any burning questions, please just raise your hand and we'll get a roaming mic over to you. So to kick off, you recently did an article which was in the Herald around Scotland's time for scaling up. So why is now Scotland's time for scale-ups?
I'm pretty positive about where Scotland is placed right now as we're seeing this shift in behaviour, investment behaviour. And as Michael's pointed out, North America, a massive epicenter of funding, has been traditionally very B2C orientated, and has also been somewhat sort of unicorn hunting. Let's spray cash and hope we get times 100, times 50s, this sort of stuff. And I think we're seeing a move from unicorns to rabbits, and a rabbit is a real actual business building interesting things. And I think in Scotland, we are very good at building real businesses. We are pretty prudent. We've got a fantastic skills base. And we've tended to build businesses in a dearth of capital rather than an excess of capital. And that creates a very different DNA and culture in your business from day one. And I think Scots are very aware of the difference. The most important £20 ever is the difference between a £10 loss and a £10 gain. And then you're in control of your own destiny. And I think we build those businesses, and you're starting to see a knee-jerk away from enormous valuations, loss-making businesses, multiple rounds, towards actually, I'd like to find more nuggety, gritty businesses that can scale perhaps a little slower, but are a better, more robust business. And I think we are fantastic at building those.
So you just mentioned the kind of nuggety investment and moving on to the larger rounds. Is that one of the things that's broken, or what is broken about our existing system?
Okay, so having said I'm pretty positive, I am very positive on the skill set. I'm very positive on the type of businesses we build. I think we can do a lot more to support those businesses and understanding the life cycle they're going to go through. And frankly, I think we can be less naive as a society about the life cycle that needs to go through. So we have and I've got, if I throw out any numbers today, which may be right or wrong, if they're wrong, it's my fault. If they're right, it's thanks to David Graham from Link Scotland, who have been just an amazing builder for the Scottish startup community. But if you look at the angel network, we've got about 19 angel syndicates. They did about 100 million last year of a total 300 million investment, right? It's big numbers. If you take that 100 million and then you look at the fact they've got about $500 million tied up, and you take the times 3 being those, the 2/3 being those who don't go through an angel syndicate. So last year, EIS registered 300 million, syndicates put in 100 million, so roughly a third. And we know the syndicates have got about $500 million tied up. So you've got 1.5 billion tied up in startups. Now, if you assume a fair return in a super healthy environment for those angels is between 1.5 and 3 times blended portfolio money back, then quite quickly you're in between 2.25 and 4.5 billion funding required to get that money back out and back into the bottom of the food chain. Now, if you take, let's say, 200 investors, both from within the UK and out with the UK, they're still writing an average check to get that cleared through of 10 to 15 or 10 to 22.5 actually million pounds, which are generally going to be £2 to £5 million deals. I'm appreciating there is going to be a small number of much bigger deals, and I think that's great. But that's what you need. And that is a huge amount of deal flow. It's a huge amount of understanding businesses that are here, staying in touch with businesses. Raising money is not a sort of, I've decided I'm going to raise money, go and have a conversation today with a bunch of people. It's a dating process that goes on for many years in many cases. Execution is a dearth. It's actually incredibly hard to execute well, and investors know it. So they want proof of execution as well as a fantastic model and business plan, and that comes over time. So when you start to throw around those numbers, you can see why it's so hard, and yet I don't think anyone is obsessing enough about it. And as a result, cash is getting tied up and blocked, and therefore not feeding back in to the very bottom end that needs it the most.
So I guess moving on from there, we've got money getting stuck. We don't have the capital coming in to move that money on and get the new companies out and get more of those rabbits that you mentioned rather than just the unicorn plan that people seem to have. Is there a role for the government in this process? What can they do to support that change from nugget investment to the much larger rounds that actually these companies need to grow and develop and get the wider investment from Europe, Asia, America?
So it's quite a big question. I'm about to turn probably into the Halloween monster in that I've got fairly strong views about what can be done, but there's a risk I'll actually end up speaking for the next 30 minutes on this topic.
I'll cut you off.
So I'll try not to. If you look at what we sort of need in the ecosystem, we need that liquidity of funding. We need skills. I think we also need kind of drivers to different stages through the business. Are the kind of 3 main areas that I've got, which let's call that incentivization to recycle or exit. Now, I've said before, on the skills front, I actually think we do very well. There's a phenomenal network to help founders here. The education system is fantastic. The breadth of the fact that people will come from all over the world to Scotland is amazing. Our brand is fantastic to attract talent. So let's assume that's in the hire area. In fact, rather than assume it, there was some work that was done that looked at when corporates buy startups here, do they stay in the UK? Do they stay in Scotland? And Scotland scores higher, I understand, than pretty much any other country in Europe for staying here. So let's take that as a validation of skills, okay? I think that says clearly people are wanting to build businesses here because we've got great skills. Then if you look at the funding piece, and you move up through that funding piece, there is not the volumes that I am talking about of VCs coming to Scotland to look at getting involved at this sort of scale. And the reason is, well, one of the main reasons is we're actually pretty small and we're pretty bad at shouting about ourselves. And if you are smaller, you need to work much harder. That's the reality. I sit on the Scottish investment panel, and that's how do we bring in 60 to 100 billion, which is incredibly hard to do. But actually, the reality is when we speak to investors, they'll say, I could write one check for 500 million, or I've got to do 5 deals at 100 million. I'm short on good people. I'm short on time. I would rather write a 500 million check than a 100 million check, unless you can make the yield better and the effort required to do the deal 5 times easier. And I don't think we think about this space from a how do we make it very, very easy for us, or make it very, very easy for investors to come here, to meet the businesses that are performing well, to build a relationship over multiple years and stay in touch. And that's where I think, that's the first area I think that the government can do quite a lot of work. And I'm going to be incredibly controversial now by saying I think the metric of success or the failing metric of success is follow-on money. So within reason, angel investments that are doing follow-on money that is not at least 3 to 5 times bigger than the initial amount means they are just doing enough to keep that business alive, right? It's because actually they can't find the cash elsewhere. If you've done $1 million and you do another $1 million a year later, that should be a failing metric. It should be a sign of an unhealthy economic cycle. So that's one area that I would dig into quite hard, and I will be very unpopular from lots of angels, and I don't want David to walk out the room having been so helpful to me when I say this. Now, if you did $1 million last year and they're doing $5 million this year, I get it, right? It's very conscious, it's very driven. I would rather it didn't happen. I would rather that money recycled back in at the start, but I do get it. So that's your failing metric. So then it's what can the government do to really drive those metrics. And I think one is a lot of work around, and I know the SDI is trying to do this, but a lot more work around about signposting great businesses and supporting great businesses. I think the other one is to do a lot more work with CFOs, FDs, CEOs, founders around about the life cycle. And the reason the life cycle is really important, I'll stop waffling in a minute. The reason life cycle is really important is I don't think many people understand that everybody watches the tear down. So the best analogy I've got for this is my brother-in-law is a phenomenal artist. And I remember once about 15 years ago, he was absolutely skint. And he said, I need to sell this collection at this level. And I said, well, Saatchi Gallery bought the whole lot last year. Why don't you just sell it to the Saatchi Gallery again? And he said, I can't. Because everybody watches the tear down. And I need to keep moving my art up and up and up and up. And I reflected and I thought, it's exactly the same for businesses. Everybody watches the layer down. So if you keep going back to the same layer, you're only being watched by this layer. And this layer right now is broken. So you need to get up a layer to then be watched by the bigger lot, and then get up to be watched by the bigger lot. And if you do not move up, you will never get out of the people that are watching you down here until one day you're just a big surprise. Like, hey, this business overnight success, 15 years in the making, has suddenly become a big business. And that's the bit we need to really nail. And right now we have, I would almost, well, we can dig into this later, but another controversial statement is I think we have an oligopoly in that space. And as a result, terms are becoming so brutal that trust is breaking down, there's already a significant lack of trust between angels and VCs. It's going to get worse. When you see 3 times preference shares, when you see the sort of stuff that people can do to drive effectively because it's a broken marketplace and therefore completely uncompetitive, it leads to a long-term failing in our economy, in our economic cycle. So what I would come back to your question, what I would get them to hit into particularly is SNIB right now is the kind of investor of last resort. State intervention was not allowed pre-Brexit. Now it is allowed, and yet we're not taking advantage of it. So I would be getting SNIB to say, yeah, I'll be investor of last resort, but by the way, anything above 2 times prefs, or actually I'd probably be harder, anything above 1.5 times prefs is seen as uncompetitive, and I am then allowed to come and play. I would take other terms as well and be very clear, this is unhealthy for the future of the country in terms of money coming out, founders doing well, investors doing well, and I'd get them to hit that space very hard. So that's the one place I'd use SNMP to effectively manufacture a set of parameters for a healthy environment. I would do, as I mentioned before, a ton on the telegraphing space in terms of where are the great businesses, what's the journey they've been on every year, making sure every quarter there's an update that goes out to 200, 500, whatever it is, global VCs. Here's how these businesses are doing. And the third area that I'd hit, which is around about the incentivization pieces, Scottish enterprise is passive, generally. Co-investment is passive. Angel syndicates are generally passive. A lot of angels are doing it, and angels are doing it to support the company, but they are not driving aggressively for a 3-year exit. One of the best ways to drive people to continue to want to scale up is from within. And therefore, I would be almost doing, and you're going to hate me saying this, given what you do, but I would be almost doing a table A articles. Hopefully some people sort of know where they are. It's effectively, if you want to set up a company, you can get a set of articles off the shelf really fast and easy. It costs nothing. And I would be looking at EMI share schemes and effectively boilerplating them and saying any startup can get set up with EMI options. You set up the staff pool, how many shares you've got, whatever it might be. I'm so sorry, Kirsty. This is a lot of what she does. And I'm saying make it free.
Don't make it free.
But I would drive incentivization and equity schemes into businesses, because I tell you what, employees won't sit around forever. They won't zombie. They all want to be getting out in 3 to 5 years, 5 to 8 years, and they'll be also asking the question, when are we exiting? What are we doing? What's coming next? So that's the other incentivization piece I'd bring in.
I would challenge some of that and say, is that enough?
Okay.
So, I mean, a lot of companies that we see every day have an EMI scheme. It's kind of a straightforward thing to implement. Yes, it costs money, but it's there. There are opportunities to get support with legal requirements, accountancy, whatever. And I understand your point around terms not being competitive enough. Something like a 2 times, 3 times pref obviously would disincentivize another investor. But is something like incentivizing your employees as they do already, is that going to be enough to dramatically change the scene, the situation we're in now, where we have lots of incredible startups, but just not enough incredible scale-ups?
Yeah, that's a really fair challenge. I would slightly cop out by saying it's not enough, but it's a start. I'm trivializing how hard it would be to bring in 200 investors, each writing a check between 10 and 20 million, or each writing multiple checks to get between 10 and 20 million pounds, right? I mean, that is the liquidity gap that exists right now. Or it's not a gap, some of it is funded, but that's the size of the challenge. And it needs to be owned, and somebody needs to be accountable for it and have a clear set of metrics, and then drive that through. And you know, if you need 4.5 billion to be coming in, between 2 and 4.5 billion to be coming in, somebody needs to be showing a pipeline that has a sort of weighted, kicks off at 50 billion and then weights down to 4.5, because let's be realistic, that's how this would work. And so by setting the objective, I make it sound easy. Thankfully, I don't have to do the how bit, which is considerably harder. But I think starting with the objectives and an owner, who is responsible for it, who is measuring it, really measuring it properly, and almost sort of taking that kind of 4 disciplines of execution route and chipping away at that piece, I think is really, really important. There is probably a much harder bit, which is definitely worth calling out, around about education. I'm amazed when I chat to like CFOs, FDs, CEOs about the lack of understanding around how hard it is to raise money and how long it takes. And when you think about you're already trying to run a business in a scale-up mode. And scale-up, I'm working with CEOs who are saying, I had 20 people 3 years ago, I had 50 people 2 years ago, I had 80 last year, and I've now got 400, and I've no idea what the hell's going on. This is absolutely brutal, because it is. You're moving to managing managers, all kinds of stuff. Like, that is all-consuming. Had they known a long time ago how to build a business that is marketable, it's dead easy. Like, I'm tracking the right metrics. Do I know how to talk about myself? Can I really articulate my purpose, my vision, my strategic pillars? Have I got the KPIs in place? If that's in the DNA early, it's actually really easy to keep that going through your business as you scale up. If you suddenly decide now's the time to raise, it's incredibly hard to build a business that is that professional at the same time as it's scaling. And I think that's an area where we could do a lot more. I would actually take that right back into schools, if I'm being honest. I would hit from the schools area. There was a guy called Ollie Barrett down south. He did what you can do with a tenner scheme. It was a brilliant scheme, and effectively gave a load of school kids 10 quid and said, what can you turn it into? So all these schools took part in the scheme, tenner each. And some of them were making £400 off their tenner. You know, it was amazing, but they started to understand return, they started to understand investment, and it's very, very cheap. The next layer up, I would hit it very hard, in that I don't understand why we try and look at what is effectively a baby in a cot and decide if it's going to be Einstein or not. You know, in Africa, they're very good with things like cleft lip operations, glasses, or just as many people as possible. Because you cannot pick, you can't say, well, I think you might be Einstein, so we'll give you glasses. Not so sure about you, we'll not give you glasses, right? We should be getting it out, smaller numbers, out. The grant applications are enormous. You know, the amount of work that nobody is, and it's because we've got to be forensic, because there's so little cash to spread so wide. So actually, I would reduce it even more, start much young and build those skills from a young age and up, and then be getting in with founders permanently around about, are you thinking about your future? Are you understanding how your business might trade, how it sells? Do you understand your metrics? All this kind of stuff, and take it right the way through. So probably that makes it sound a little harder than it did when I just came up with my 3 points earlier on.
No, that was very useful. I've seen the attendee list for this event, so it sounds very much like you're asking everyone in this room to play their part in that education piece, from kind of government agencies and bodies up to investors and their investor directors on boards, and people like yourself who advise scale-up companies, and also us as advisors, CT, MBM, etc. We're all responsible for educating people and supporting them to get to that next step. Is that fair?
It is fair, and I think actually we're very good at it. I think, you know, people who help companies really help them. I think where it falls down, so a couple of things. One, I would say execution is a rarity, not a given. It's blown. I've been really staggered by how bad a lot of businesses are at executing and how big they've managed to get. And so I will sit down with somebody and I'll have a chat, and this might be a reasonably sized business, so employing 30 people, 50 people, 10 million turnover, that sort of number. And I will, you know, chat with the CEO as a sort of coach, advisor, and I will coach out of them, what is your purpose, where's your vision, okay, kind of what are the bases to get there? Okay, great. And they will eventually narrow down, what have I got to do first? Because that's the hardest thing, right? It's just overwhelming. There's too many things to do. So you coach out, right? What is first base? And a month later, we'll catch up, or 2 weeks later, or probably a month later, we'll catch up, and I'll say, how's first base going? And they'll say, I've been thinking about third base. And I don't think it's quite right. I'll go, okay, how's first base? And I'll say, we'll get to that, but I need third. Now, everyone probably in this room knows that third base is going to change massively over the next 2 years. But they'll spend, and then a month later, I'll catch up again. I'll say, hey, look, how are you getting on with like the basics? I've been thinking about fourth base, and I think this is, and you realize people are not good at nuts and bolts execution. So it's more than just advice. You know, actually, sometimes advice can be quite meddling and quite dangerous. It's building a knowledge set of skills from a CEO, COOs, I would get like ops really cranked up. And actually, again, in Scotland, I think we are good for it, but getting that prolifically out there, I think is important too. So there's mentoring that's needed, but there's more than that. And I think this is, again, where I think VCs are very important, because my observations of boards for startups are they're almost exec meetings with 3 advisors in the room solving tactical problems. And you'll sit down, and the person's there, like advisors there, non-execs there, saying, well, like, here's how I would solve that problem, or I can introduce this business to you, or a completely tactical response to stuff. It doesn't have the discipline that when you sit down and you've got covenants in place, or when you sit down, you have to deliver certain targets for a budget that you have agreed with a venture capital company, minority or majority, and they are there every month saying, what is going on with this? What are you doing in 3 years? What are you doing in 2 years? That discipline, and this is, I probably should explain better why the tier down thing is so important. If you keep operating in a world where you've got an advisor that just sort of nudges you or says, I could solve that problem for you, or I'll help with that, it's not the same as every month having to turn up, consistent message, how's your team doing, where are you up to, where's the budget, and that professionalism comes in each tier you go up with investment. So it's really important that everything works together.
It's about accountability, is what you're saying.
It's about accountability. That's one of the things I'm saying.
One of the things. Well, we've heard a few kind of controversial statements from Shane and lots of insight. Would anyone like to ask any questions to give me a break? Sure.
Kirsty, thank you. Good morning, Shane. Thank you for your comments. I never thought I'd be sitting in a conference event about scale-ups, hearing a CFO of a unicorn saying we need less unicorns and more rabbits. But I think you're right. I guess my question, Shane, would be, can you maybe give us a bit of a sort of look into, what happened at Skyscanner? Because you said 15 years in the making. It wasn't an overnight success. At some point it was a rabbit. Presumably it grew into, I don't know, a greyhound or something before you moved on to the unicorn thing, because you raised a couple of million from SAP, and then you raised your big bucks round, whatever it was, 160 odd million. Can you just tell us a little bit more about how you were growing and scaling within the business, and what you feel were the kind of the points of real transformational change, so that anyone in this audience who's thinking about, well, we can scale up, what was it? Was it the fact that the investors brought governance, or was it those share schemes that you talked about? What do you think was the sort of secret set of ingredients that helped with the scale-up journey for Skyscanner?
That is a difficult question to be succinct about. So I joined Skyscanner just tail end of 2011, about 50 to 80 people. Amazing product. Had hit that sort of inflection point of scale that happens when you hit 50 to 80 people. Most people join a startup because the founder is hugely inspiring, can lead the way, and they follow that founder. But the minute you put layers in, which you need to actually manage a 50 plus, some of that magic goes and can't be translated down multiple offices, whatever it might be. And I would say Skyscanner at that point had a brilliant product, just needed some unlocking. And I was lucky that I think we joined the same day as Mark Logan, who had a hell of a lot more impact than me. And he was very good at bringing to the fore the fact that we are a people business, and the only asset we have is people. And we have to make that work as well as possible. So I remember him saying people are no longer joining for the dream, they're joining for a career, and therefore we need to help them be the best they can be along that career. And my role in that, in terms of actually how do we measure that, and being very metrics orientated, as well as EMI share schemes and the such like, Gareth with the vision of making sure we always had this long-term disruptive view of where we might go, and Mark pulling together the people and the power of the people piece, I think was probably the combinations that managed to unlock and stop us stalling at 80 to 100 people. And then we went through a series of inflection points, and just being always very conscious that your business inflects, you have to change something, you have to change quite a lot of stuff, and you've got to predict it coming. The other thing, I think we were a rabbit, to be honest. The only year that Skyscanner didn't make a profit was the year after SAP invested, kind of on purpose. It was like, raise some money, spend it, come back up, and then I held EBITDA flat at 20 million for 3 years. that's pretty hard to bring an investor along that journey and say, I'm going to keep us flat. And SAP were magic with that. And I said, we're just going to reinvest in, because what will happen is you'll get operational gearing. That will kick up through, and eventually, effectively, your contribution will grow considerably faster than you can grow your overheads, and it just pours through to the bottom line. So having that strategy and that long-term view was really important, and that understanding as a unit that we were going to take our time to build this business, hold EBITDA flat, and then come back. But that with the wrong partner, I don't think I would have got the response I got to, this is what I'd like to do. So there was a whole bunch of things that allowed it to build to that level of scale, but people was at the heart of that, people and skills. I think the share scheme really worked. Another thing that works really well with share schemes, and I think is the most important bit, is they're actually really expensive, right? You're giving 5 to 10% of your company away, and often people who get or sign a piece of paper have no idea what it means or what it's worth. And what we got quite good at doing was doing a share buyback at the same time as launching a times 10 strategy, which I think we certainly did twice. And it's amazing when you buy back. It was completely voluntary, but if you offer to buy back, if people want to sell, let's say 10%, and they get £10,000, and then you say, here's our times 10 strategy, very quickly they go, oh, that's worth £900,000. With the 90% I've still got left business, which clearly it's not, but it has a huge amount more impact, because they're like, that's material now. That's I mean, that £10,000 was wonderful. I really want that 900,000. Even if it takes me 3 to 5 years' time, that times 10, so they listen and they really hit the times 10 number. So I think it's not just when you put the scheme in place, it's then what you do afterwards that's really important, which again is about that flow of liquidity and cash that's so important. There's a few bits. I mean, yeah, there was a lot. It was a busy time.
I think we've got time for one more question. I'm looking for Susan to give me a wave if I'm in trouble on overtime. Anyone got anything? Everyone's remarkably quiet. Okay. In that case, I'll ask one more question. So you've mentioned a lot about Scotland has a great skills setup. We're really built up. So what's the next level? What's the next thing that can happen to build on the existing skills that we have to get those scale-ups out there? And I guess you see it every day. You're going in and advising and you're telling them about these benchmarks and getting first base and second base. What more needs to be done?
So I think as people are realizing, I tend to talk in extremes and therefore be quite controversial, not because I necessarily believe it to the extremes that I've mentioned it, but it's the point I'm making. And I would say we need more failures, more failing businesses, right? Significantly. The hardest graft, when you really learn the stuff I'm talking about execution, funding, your bottom line, those numbers, is when you're failing. And it goes back to my point of why I'd give a whole lot more businesses. I mean, I loved seeing the Scottish Edge finalists announced this morning. Some of the businesses in there are staggering. But what worries me is how many therefore didn't get funding, who are equally interesting and therefore won't go on this journey. That's Halloween for you, of success or fail. But the more we can get people churning through startups and learning, the better. So I would, the worst thing for everybody is zombieing companies, right? It's disastrous for investors. You're not really learning much in those businesses because it's not a hyper-growth environment. It's do the same this year as did last year, just do it with the minimum funding as I can manage and just try and scrape by. So I think we need to really be celebrating business losses. In the US, they quite often have wakes, and by the end of a wake, everybody is rehired into another company. We don't have that culture here. And at the same time, I would have businesses becoming, learning from that and fail early when it doesn't matter. Like it's cheap, it's easy, but then build the rabbits, build the real businesses coming through with that skill base, and then fix the funding cycle above it.
Not too much to ask then. I think we've got a question from Poonam actually at the front, if we have a mic somewhere. If not, I can just dash down.
Thank you, Shane, and thank you, Kirsty. You mentioned the culture of failing. I suppose the question there is that with that failure, where are you going to get hired, and which are the investors who will take the bet on it? Because you initially mentioned we have lots of skills, but if there haven't been lots of scale-ups, where is that leadership experience? I suppose if you take back your own Skyscanner experience, what was your experience when you were trying to hire senior roles, say VP of engineering or something like that? Was that available here? And if not, where do you go for that? And relevant question related to that is, funding-wise, you said that 10 to 20 million gap or 20 to 30 million gap. If that's not floating about, how do you attract those investors to build the companies here? Or did you have to consciously take a step, say, I'm going to move somewhere else, raise somewhere else, even though if it's based there? I think that is a journey that will be important for people to think and learn about, because most people think you can carry on that linear trajectory, whereas that's not always the case. I think so those 2 points, skills are there, but are they at the right level available? And funding is there, but with the failures, is it available?
Yeah, no, two great questions. So the skills, but I was talking about with the failure side, I would like to see much more at the very bottom level. Right? I wrapped up my first business, effectively failed it, and I learned more than I could have ever learned in that 2 years. I ran my diary at 15-minute chunks. I went full tilt, and I learned a ton. And now, when I spoke at school recently, and they said, how do I get an internship? I was like, don't get an internship. Borrow 200 quid off your parents, buy a load of stuff and try and sell it. And I genuinely mean that. I'm like, learn the hard way at the very bottom end. We need businesses at the kind of Scottish Edge and lower level, the 100 grand space, growing, failing. So that doesn't clash with my rabbit side of building profitable businesses. I then think that comes through, and I think where you're targeting is more the kind of proper scale-up stage. I exist in a sort of 10 to 15-year view rather than a current view. If you can build the cycle correctly, you will have more people learning in an accelerated learning environment and therefore becoming highly accomplished at working in that scale up and above, up to unicorn type stage. So I think we can grow from within for sure. In the meantime, it's very hard to recruit in. And we found it very hard. And we fought opening a London office for as long as we could. But the reality is, it's very hard to entice people out of the US to come to Edinburgh. And then they look at our tax structure as well, and they say, I really don't want to come to Edinburgh. And you're like, well, actually, how do I pull in that level of person here? So I agree there's a problem there. I'm more of the view of let's take the 10 or 15-year view. Let's build a 10 or 15-year strategy, and let's grow a lot more within. And in the interim, you do just have to hack it, overpay, whatever it might be. Again, and this ties into your second point about the funding pieces, the more sophisticated your investor, the more help they are with that sort of thing. So, for instance, we never needed money past the SEP money at the very start. The Sequoia deal, we didn't go looking for. I would keep a bunch of investors up to date, just in case one day we did want money, if we wanted to go into a big M&A splurge or something, but we didn't. And they came to us and said, we'd like to invest. And we initially said no, and then we said, I'll tell you what, we'll come over and we'll have a look at what you do and why you're so successful. And we flew over and in 3 days met 21 businesses. LinkedIn, we went sort of, though they didn't invest in Facebook, we went to see Facebook, went to see Airbnb, all these companies, how they were operating. And in that was, in terms of accelerated learning, and most of my life has been one of accelerated learning, those 3 days, off the charts. Absolutely off the charts. But they also had a major marketing arm, and they'd got a load of entrepreneurs and residents, and they had a brilliant recruitment arm that could do exec search, and they could back channel reference pretty much everybody in the industry. That's what I'm talking about when I say you've got to keep moving up, because it would be unfair to expect a small, VC to have that level of knowledge, firepower, resource. They don't, and therefore you've got to keep going up. So that funding piece was solely about access to that. The cash came in and sat in the bank, never spent it, never needed it. Had to show some degree of primary, so they felt they were getting growth for it. Exactly the same when we did the 200 million at $1 billion round. Didn't need the money. We'd built a rabbit, a real business that was kicking off profit. But what we did need was access to other things. We were wanting to keep options open if we did want to IPO, and therefore having a cornerstone at Bailey Gifford would be super helpful. We wanted to get some money back to investors who'd been in a long time, who'd been very patient with us in terms of our, let's hold EBITDA flat for 3 years. That'll be a great conversation. And they were brilliant with it, and it kicked through. So let's get some money back to them. So it's very strategic how we played that game of chess, I guess. But it wasn't for the money. I don't know if that's answered your second question.
Thank you so much, Shane. I'm going to wrap this up now, but thank you so much for coming along and for answering our questions.
Thanks for having me.
I think the Kirsty and Shane show will be back for another instalment at a date very soon. Fabulous insights and great kind of conversation. Thank you both for that.